Good morning to you. My name is Philip Allen, Director of Learning at the BBA, and today for the next hour to discuss the FCA's 2017 Business Plan and Supervisory Priorities, I'm delighted to be joined this hour by Bernadine Rees, Managing Director, leading Protiviti's regulatory practice in the UK, Derek Cummings, Director in Protiviti's UK Business Performance Improvement Practice, and Stuart Campbell, Director in Protiviti's UK Regulatory Practice. Just before I hand over to Bernadine, I'd like to cover off a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webinar, you can click on the Q&A widget at the bottom and submit your question. We will try to answer these during the webinar, but if a fuller answer is needed or we run out of time, it will be answered later by Bernadine, Derek and Stuart via email. Please note that when you ask a question, your name and your organisation is not disclosed to other webinar attendees. A copy of today's slide deck is available in the resource list widget in the green folder at the bottom of your screen. If you want to contact Protiviti directly, please click on the email envelope next to the presenter's photo. To the right of the resource list, you'll also notice a survey icon that if you click on, it just asks a couple of questions that will help us understand your training needs and requirements. Please also feel free to follow Protiviti on Twitter using handle @ProtivitiUK. You can expand your slide area by clicking on the Maximize icon on top right of the slide area or by dragging the bottom right corner of the slide area. If you do have any technical difficulties, please click on the Help widget. It has a question mark icon and covers the most common technical issues. An on-demand version of the webinar will be available approximately at 4 o'clock today and can be accessed using the same audience link that was sent to you earlier. We intend to present for 45 minutes and then answer your questions for the remaining 15 and 20. Bernadine, over to you.
Thank you, Philip, and good morning, everyone. A very warm welcome to the webinar, and thanks also to the BBA for inviting us to speak today. Just before we start, I'd flag up that given the timing of the webinar today, we've been asked not to speak about Brexit, but of course very happy to speak offline on that topic, as it is covered partly in the business plan itself. Right, so I think we'll jump straight in. These are some pictures of who we are. I'm not going to dwell on that for very long. Straight into an overview of the plan. So as in previous years, the FCA's business plan for 2017-18, which was published in April, sets out its risk outlook for the year ahead. This year there are 6 cross-sector priorities, themes that are an area of focus, as well as sector-specific priorities for the next 12 months. So first up, we can say that not all of the business plan is new, obviously, and much will be familiar from the FCA's previous business plan, including areas such as embedding the senior managers and certification regime, and of course the planned extension to other regulated firms in 2018, the implementation of MiFID II, a continued focus on the link between culture and poor conduct, and improved oversight of AML functions and the technology that can help in this sphere. But there are some new areas of emphasis for this year, and perhaps an overriding and underlying theme for some of the business plan is the focus on technology. So RegTech and innovation and how these can be used to increase competition and efficiency and reduce costs is something that recurs throughout the plan in different guises and flavours. And also cybersecurity and systems resilience has a renewed emphasis this year, perhaps not surprisingly. So the FCA's business plan is built, as I mentioned, around the 6 cross-sector priority themes, which will inform its approach to its core regulatory activities and are intended to drive the direction and decision-making on specialist work streams such as thematic projects, market studies and policy development. And these 6 areas are shown across the top of the table in blue on the slide. So they are, in turn, the firm's culture and governance, financial crime and AML, promoting competition and innovation, technological change and resilience, treatment of existing customers, and customer vulnerability and access to financial services. In addition, I mentioned that the FCA has published its priorities for 7 specific sectors, highlighting key issues in each sector and its view on how the sectors are performing in relation to these. And these sectors are shown down the side of the table in blue here. The slide aims to show the key areas of focus by sector, but of course firms and banks across all sectors will to a greater or lesser extent be affected by each of these cross-sector priorities. But for the purpose of our webinar today, we're going to focus in a bit more detail on the cross-sector priorities. So I'm going to move on now to the first of our polling questions. So just to enable us to get an idea of our audience, it'd be helpful if you could choose one of the following options that most closely aligns with the area of banking that you work in. Great. So I think you can see the results there. A strong audience from retail banking, and but a good spread across commercial and investment banking as well. So that's helpful for us. The next slide shows some of those sectors and sector-specific issues highlighted in the business plan. Showing an analysis by policy, by supervisory priorities, new areas, and so on. We're not intending to go into this in any level of detail in this presentation. It's for information, but obviously if you want to pick up with us afterwards on anything that's here, more than happy to do so. I'm going to hand over now to Stuart Campbell, who's going to talk a bit about the first priority, which is the firm's culture and governance. Over to you, Stuart.
Thank you, Bernadine. Good morning, everybody. Culture and governance and its impact on individuals, firms, have been at the mainstay of UK regulators' policy and supervision for many years. And the business plan makes it clear that it will continue to be a priority for FCA during 2017-18. The FCA recognises that culture is the product of a number of different drivers and is shaped by a number of influences drive behaviour of individuals within an organisation. We specifically refer in the opening paragraph of the section on culture and governance to tone from the top, centre structures, and the effectiveness of management and governance in contributing to the overall culture, whilst recognising they are just some of the factors that influence culture and behaviour. For FCA, the most significant drivers of behaviour are senior management accountability, remuneration, the steps being taken by management to address risks caused by behaviour. One assumes they mean risks caused by poor behaviour and conduct. It's worth noting that FCA makes a point of emphasising that they're interested in the direction of travel in terms of cultural change and the indicators that demonstrate that progress is being made. There's no reference by the FCA to the pace of travel that they are expecting. I'm going to focus this morning on the embedding of the senior managers regime and on remuneration. And we'll do so by looking at what FCA wants to see happen, their desired outcomes, what they plan to do over the next 12 to 18 months, their priorities, what firms, you, should be thinking about doing in response, and suggest some questions for you to take away this morning. So what is FCA looking to achieve? What outcomes are they focused on achieving? But the interests of consumers are at the centre of what you do. It isn't change for change's sake, but changes that will protect consumers or improve their experience of the firm throughout the customer journey. that there is an appropriately shared sense of accountability throughout the organisation. So this affects everyone, while the most senior individuals retain responsibility and accountability within their areas of activity and for the material risks that arise. So how well do all those in the scope of the regime understand their personal liability? But senior manager and certification regime is not just a paper exercise, but senior individuals are able to firstly articulate the firm's approach towards their conduct with consumers and in the integrity of the markets that they operate within, and that this is embedded within business process for marketing and product development, how fees and charges are determined and explained, customer onboarding processes through the transaction life cycle, when things don't go too well, like handling and so on. Secondly, explain the culture they are creating and the consequences or the effect of that culture in terms of the behavior it could or does create, and the risks, and what is done to control or oversee behavior and conduct. That there are appropriate effective processes to identify and deal with poor culture, and that lessons from mistakes are taken, possibly looking at what happens elsewhere and asking if how and in what way similar behavior or conduct could arise within our organization. So, for example, you might have an aggressive sales or revenue culture, and in that context, you will need to show how your systems and controls are effective with regard to suitability. Staff are trained and monitored. Staff know when not to pursue a sale, maybe identifying a vulnerable customer, for instance. That incentives do not bias judgment, and you think about the unintended consequences. And surveillance and intervention processes that would spot issues and deal with them promptly. Sales is but one area. There are others, of course. The risk outlook prompts thinking around the challenges of meeting the needs of the UK's changing demographic, physical and mental well-being of an ageing population, and financial needs of future generations. We'll touch in particular on vulnerable customers and the treatment of existing customers a bit later. So nothing too controversial. There are a number of activities that FCA plans to carry out during the next 12 to 18 months. Unsurprisingly, to embed the supervisory processes with the senior manager's regime, questioning and challenging how integrated the regime is within deposit takers' CRA-designated firms. During authorization processes for new individuals entering the regime, the pre-approval process is proportionate and risk-based. Somewhat ominously, begin to use the responsibility maps in earnest, if they haven't already, and I'll come back to this. As previously announced, FCA will begin the extension of the regime to other firms due for implementation sometime in 2018. Consultation due quite soon. Going to continue to work with firms around the linkages between pay and risk, discourage short-term and excessive risk-taking, and encourage sound and effective risk management. So presumably more scrutiny around risk appetite, risk limits and risk reporting, as well as following through changes in the remuneration code. A clear message from SCA is that they will continue to look at a wide range of tools where they see or perceive issues with culture conduct. One imagines this would include things like skilled person reviews, investigation, enforcement and discipline as they see appropriate. And then continued speeches and influencing of firms, keeping up pressure through dialogue with other regulators, and there are signs of interest by other regulators globally on issues to do with conduct, culture, accountability, and engagement through the media and being held accountable to Parliament being some of the stakeholder communication that you have in mind. and it can be helpful to monitor what they're saying and look for emerging patterns of focus or themes. Well, so much for the FCA's views on what they're looking for in terms of outcomes and their planned activities. What practically can firms be doing? The business plan suggests the following: keeping the topic of culture and conduct behaviour high on the agenda of senior management and of the board, continuing to focus on conduct risks, identification, measurement, tracking, monitoring, surveillance activity, and reporting. What is the direction of travel? Can progress be demonstrated in terms of any change in culture and improving conduct? Working at embedding conduct risk and good risk culture across the organisation, along the customer journey throughout a transaction lifecycle, and looking at the causes of errors and issues as they're identified and working out what is really needed to prevent them happening again. So, a few questions for you to take away. What processes are in place to ensure the effective maintenance of responsibility maps and individual statements of responsibilities? How does risk management reporting support current responsibility maps and individual statements of responsibility? How well can senior managers explain our principles of conduct towards consumers and markets? How are they incorporated into decision making? How are the linkages with individual reward? What are the cultural changes and improvements we're looking to achieve? In terms of demonstrating progress, what indicators do we use to track that progress? How are these defined, and what risks are they intended to be used to monitor and track? That's all that I want to cover at this point. I'll hand over to Bernadine.
Thanks, Stuart. I don't think we have any questions in at the moment on that section, but you feel free to submit any questions you may have. The second cross-sector priority we'll cover is financial crime and anti-money laundering. I'm sure it will come as no surprise to everyone on the phone that financial crime and AML have made it into the FCA's cross-sector priorities. It's been an area of huge focus for many banks over the past few years. Against the backdrop of considerable regulatory and legislative changes, the FCA, I think, is recognising the balancing act many banks face by responding to increasingly complex and multifaceted AML and financial requirements, while at the same time trying to maintain access to as many firms and users of the financial systems as possible. Indeed, it's just not an easy thing to get right. As you'll know, the FCA has been vocal about the roles that banks must play in adopting a risk-based approach while not inappropriately de-risking their customer base. And this access to the financial system for consumers and certain customer segments, such as the Money Service Bureau, for example, will remain an area of focus for the FCA. The FCA is also looking to focus on fraud again and scam prevention and awareness. This year is particularly a target for those scams which are targeting customers' pensions arrangements. So moving on to the FCA's intended areas of activity for this year in financial crime. The FCA will be scrutinising the regulatory returns that many banks and firms submitted to generate risk indicators that can be used to confirm or refine their approach to AML supervision. So while this may have been done on a firm-by-firm basis historically, the financial crime returns provide the opportunity to conduct analysis of risks across the industry and by sector and so on. So a greater use of some of that regulatory reporting and information. There are lots of changes to the legal and regulatory framework this year, with the fourth Money Laundering Directive coming into effect this month in the UK via the Money Laundering and Transfer of Funds regulation, and the accompanying changes to the JMNST guidance note, so on, as well as the Criminal Finances Act, and proposals for changes to the fourth Money Laundering Directive, or some call the fifth Money Laundering Directive, also under consideration. I'll mention some of the key changes introduced by the fourth Money Laundering Directive in a moment, but the changes being discussed at the European Parliament level at the moment, changes to the fourth Money Laundering Directive, are aimed at responding to perceived lack of transparency highlighted by some of the European terrorist attacks of recent years, and also the Panama Papers and tax evasion issues. So, as I say, this is very much at the discussion and consultation stage. The FATF mutual evaluation of the UK is due to take place this year, and the FCA is a key part of their agenda. However, I suspect the impact on many banks will be minimal. The FCA takes on formal powers, again, new formal powers to be the supervisor of supervisors even, overseeing the role played by professional bodies in the AML framework, such as the professional bodies of accountants and lawyers. This has been something of a perceived weakness of the UK financial crime system for some time, so it's probably timely that plans are set in place at the time of the FATF mutual evaluation. But again, the immediate impact on banks may be limited for the moment. I mentioned earlier that limiting access to certain types of firms or sectors continues to cause difficulties, and the FCA has framed this in terms of firms adopting a more sophisticated risk-based approach rather than, as they see it, blacklisting entire sectors or subsectors of clients. Of course, this is something of an evolving area, not without its own cost implications, but it will continue to be an area of FCA focus. In keeping with its stated desire to continue and consider and use technology more effectively in the regulatory sphere, the FCA has undertaken a study on the use of technology in AML and intends to publish the results of that study this year. And I'm sure this will prove interesting reading for those looking at various applications of new technology in the AML environment. And indeed the FCA's expectations and possible concerns in this area, and more from Derek on the use of technology in a moment. Investment scams and fraud that fall within the FCA's remit will be another area of focus, and in particular the Scam Smart communication campaign that's been running already will be extended. And as I said earlier, there's this focus on pension scams too. So some things that banks should be doing, what would be on an MLRO's to-do list this year, probably quite a long to-do list. I'm going to bring all of these up because there is some natural overlap with the previous slide. There's a fair amount to be done in terms of evaluating a bank's policies, procedures, systems and controls in terms of revisions to take account of changes introduced by the fourth Money Laundering Directive. At Protiviti, we're seeing clients looking at their PEP policies and their approach to risk rating foreign and domestic PEPs in a much more meaningful way. Also, their beneficial owner policies and the use of the increased information to be available in beneficial ownership registers. Other issues include the removal of the automatic entitlement to apply simplified due diligence to specific customers and products, and perhaps looking forward to greater focus on transparency in relation to tax evasion and terrorist financing activities. There is also likely to be food for thought in a number of other areas, including new technologies, the need to improve transaction monitoring, and dealing with the FCA's concerns and de-risking. In short, the pace of change in AML remains high, as it has done for a number of years, and is likely to continue for some time. I'm going to hand over now to Derek, who's going to talk more about technology and resilience.
That's great. Thanks, Bernadine, and good morning, everybody. So as Bernadine has touched on there, and as she mentioned up front, technology really is a rich vein running through the FCA's plans, and now they're putting this much more at the front and centre of their business plan for the coming year. Technology is seen as presenting both significant opportunities to create a more competitive environment, as well as a source of a number of underlying risks. The FCA have pulled out these two key things in their plans to provide a focus and to lay out how they're seeking to balance risk against innovation. So the first area that we'll cover off is technological change and resilience. And we'll start by taking a look at this from the FCA's perspective. There are a number of main themes running throughout this particular area: cybersecurity, resilience of legacy IT systems, and the management of third-party risks relating to outsourcing of IT. So first of all, to cybersecurity. Now, this has been a hot topic for some time, and it isn't going to go away or to be diminished in its importance. Recent ransomware attack, which impacted a number of countries and companies, including our own NHS, so dramatically, has reminded everyone of the need to remain vigilant and to be prepared to respond quickly and effectively to emerging cyber threats. The FCA is reflecting this in its business plan going forwards. It's important to note that the FCA has recognised the need to increase its own specialist resources in this particular area. The FCA expects banks to do the same and to invest appropriately in skills and capabilities in this area as well. Legacy IT systems are a reality for many banks. Even some of the newer challenger banks at their heart are actually relying upon software which was originally developed sometimes over 30 years ago. Complexity of IT systems is a concern, and the FCA is looking to banks to ensure that the inherent risks are understood and are being carefully managed. Although not a banking-related example, anyone who experienced the recent British Airways outage will have a first-hand experience of the potential impact of legacy systems on customers. There are a number of recent examples in banking too, which is why the FCA is giving IT resilience a prominent focus. The complexity of IT systems and reliance upon knowledgeable IT resources is further compounded when IT delivery is outsourced to third parties. While this can shift some of the risks, as well as enabling costs to be better managed, outsourcing does not shift the bank's obligations to deliver services. That's made clear by the FCA. So, given those priorities from an IT resilience perspective, how should banks respond to this? So some of this is about continuing what is being done already, but to recognise at all levels in the organisation the importance of IT and IT risk management. The need to continue to invest in cybersecurity, ensuring that relevant staff are plugged into their peers across the industry to develop and share best practice. This is a problem that's shared by all banks and many across the financial services industry. More that can be done to work together can help to address some of these concerns. Cyber is a constant game of cat and mouse. There are professionals as well as state-sponsored actors out there who've got access to targeted resources, and some of those more resources than actually the majority of UK banks. So we need to keep on the front foot as bankers. We need to engage fully in industry-level war games and scenario exercises, many of which the FCA and the Bank of England have been running over the last few years and continue to do. Banks also need to look carefully at their legacy systems and ensure that they have identified the risk areas from a resilience perspective. Banks shouldn't simply rely upon IT disaster recovery testing. The issue of business resilience is a much broader topic and includes being prepared to respond to situations which require clear communication and response to customers. Also, there's a need to consider knowledge management risks, including your reliance on the knowledge and experience of key third-party suppliers, particularly where legacy IT systems are concerned. It's worth noting that the FCA is stepping up its game in this area in terms of bringing on board its own expertise. So therefore, one of the other things that banks need to consider is ensuring that as well as having technical experts in-house, you also have the ability to engage in those technical level conversations with the FCA as the regulator, and be prepared to be challenged by them as they bring that additional expertise on board. That really covers the area of technology change and resilience. Moving on, however, to some of the more positive aspects of technology, which is really in the areas of promoting competition and innovation. Now, the FCA has actually been at the vanguard of promoting competition and innovation, particularly through technology now, for a number of years, particularly in the wake of the global financial crisis. In many respects, the FCA's latest plan is clearly emphasising that it will continue down this path. In fact, from a Protiviti point of view, as part of developing a compliance officer training course for a major UK bank over the past few days or so, we took the opportunity to take a look at regulation and regulators across the globe. And actually, it was interesting to see how far ahead the FCA is and actually how many of the other regulators on a global basis are following in the direction that the FCA has already set. So it's quite good from a UK perspective that the FCA are seen at the forefront in terms of promoting competition and thinking about how the risks of technology and the opportunities of technology can actually be managed going forwards. There's a clear recognition of the importance of fintech innovation, deliver increased competition, and to improve consumer and business outcomes. There's also recognition within the FCA's business plan, creating a more competitive environment across the financial services industry also has a possibility to impact costs and therefore to bring down costs for consumers and businesses going forward. As well as that, it's looking to address still the too big to fail issue, which came out as part of the global financial crisis, and it underpins the desire to create a more competitive banking and lending environment. What exactly does the FCA plan to do? There are some specifics in there, and again, there's not a lot of time to cover off the details on this webinar, but a few key themes that I've looked to bring out as part of this. Project Innovate, Regulatory Sandbox, and the new Bank Startup Unit will all continue. These are seen as being successful and as enabling the FCA to engage directly with the industry in a way which is encouraging innovation and delivering successful outcomes. There's a recognition also in the business plan there's a need to extend this current engagement outside of London. There's an international dimension to this, as well as a regional dimension. London is clearly a successful global hub for fintech innovation. However, there's a need to extend this reach and connect with other regulators across the globe, as well as to extend fintech and the FCA's engagement across the rest of the UK. Automated advice is an interesting area to bring out, and I noted from the poll earlier on that we've actually got about 13% of the audience who has identified as being in the wealth management or private banking sector. And Bernadine touched earlier upon the fact that the consequences of pension freedoms, for example, is receiving some attention. So in this area of automated advice, or so-called robo-advice, it now has particular attention in the FCA's plans. Clearly in response to both the post-RDR advice gap and also, as I said before, the pension freedom. The FCA is therefore establishing an advice unit to provide guidance to firms and technology companies who are seeking to provide more technology-enabled solutions in this specific area. This is a direct recognition of the growing role which intelligent automation can play, as well as the way in which technology is now so embedded within the lives of consumers. The last point to note here is the role which data gathering will play in regulating the industry going forwards, with an indication that real-time, near real-time reporting will become increasingly important from a regulatory perspective. So, what should banks do in response to this? Maybe the first point to raise here is PSD2 regulation. So fully engaging in PSD2 is an important aspect for all banks and all financial services. This will change the shape of payments across the industry. There are both opportunities and competitive threats in this area. Both need to be understood and embraced. PSD2 should not simply be viewed as another regulation which needs to be complied with. The advent of open banking APIs will see a fundamental shift in the competitive landscape, both existing banks as well as challenger startups. It creates a much more level playing field in relation to everyday banking for consumers as well as small businesses. Secondly, firms should look to leverage their relationship with third parties. Decide where you want to develop internal capability to innovate, where third parties will help you access a much broader capability, as well as provide access into this fast-moving world of technology change. Key message, sort out your data. Data is the lifeblood of your business. You'll increasingly need it to make rapid decisions and to balance risks against opportunities. Problems of legacy IT systems, which we touched upon earlier, has also created significant problems in this particular area. The FCA and other regulators will increasingly expect real-time feeds of information running through your business to spot trends and exceptions, as well as to understand how well you're managing your business. Don't be caught out by this. A mammoth task for many, but it's no longer a nice to have. Automation of controls will become increasingly important as a direct consequence of this. And looking at digital transformation overall from a firm-wide perspective, creating an environment in which your own business embraces innovation can be very challenging, especially for large and well-established organizations. Banks should look carefully at your culture, look at your risk appetite to set an appropriate risk appetite not only for running your existing banking operations, but also for innovating and embracing some of those technology opportunities. Look to the examples of Uber and Airbnb to see both the benefits of innovation as well as the risk of disruption across entire market sectors. So innovation is an area we could talk on for hours, and we may well get some questions later on. However, time is short, so we do need to press on. We do, however, have a couple of polls just to kind of judge in this area of technology what the feelings are out there in terms of the audience. So, Philip, I wonder if we could pass out the next poll, please.
So, next poll, which technologies or areas of innovation do you think will have the most significant positive impact on your business over the next 3 years? Which technology or areas of innovation do you think will have the most significant positive impact on your business over the next areas?
And obviously, we haven't introduced this list of technologies, and we could have had a much longer list of this. You may or may not be familiar with some of these terms, but really we want you to take a look at your own organization and your own level of understanding, particularly to consider that kind of 3-year time horizon.
Do you want the results now, or do you want to skip to the next question?
No, we'll take the results now, I think. Philip? Okay, so interesting. So 37.6%. Looking at the AML and KYC utilities, which is what Bernadine touched upon before. And there are a number of different technologies which are actually used in that particular space, biometrics, for example, as well as artificial intelligence, which is sort of coming at the second. Big data analytics, getting about 15% of the vote as well. Interesting set of results.
Do you see that across, regardless of the size of the firm, or in what areas of banking?
But a lot of this again depends, on the actual sector of the bank itself. AML and KYC is clearly a common problem across the entire financial services industry, and something that's been struggled with for a number of times, which is why it's emphasised so much in terms of the FCA's business plan going forward. So yeah, that's interesting. Big data and analytics, we see a lot of focus around that at the moment. A lot of experimentation going on and looking at how the business benefits from that. But given the fact that there is this legacy data problem that banks are still looking to grapple with, still kind of early days in terms of starting to see results of that coming.
And in terms of AML, KYC, is that because headcount's not increasing and they're looking for technology solutions to address that area?
Absolutely. I think we are only seeing a ratcheting up of requirements across financial crime more broadly. So a lot more coming into the financial crime net that is caught by financial crime compliance, AML. So the requirements are increasing, the expectations are increasing, but as you say, costs and budgets and headcounts are generally under scrutiny. And so the only way really to deal with that is through the smart use of technology. But that doesn't come without its own challenges because of legacy systems, incomplete data. But that does seem to be the way firms are planning for the next 5-10 years. Changes.
Maybe, Philip, we can move on to the next poll question. So the distinction here between which technologies are likely to give the biggest benefit versus those which are likely to cost the most for firms over the next few years. This is where we come to our second poll question. Philip.
Okay. Which technologies or areas of innovation do you think will consume the most resources time, money, expertise, etc., across your business over the next 3 years? I can feel the gasps and the oohs and the ahs already. Which technology or areas of innovation do you think will consume the most resources across your business over the next 3 years?
Yeah, okay, so a similar result there in terms of AML and KYC has been a key focus area. Again, just the rest of the results. We see quite a lot there in terms of the open banking APIs piece as well. Again, as I mentioned before, PSD2, an extremely important area of regulation here for the payment services industry, has been consuming a lot of time and attention, over at least the last 18, not 24 months in terms of the way that regulation has moved forwards. So again, we'd look for that to continue throughout the next couple of years or so. Again, we're also seeing big data analytics there being an increasing area of importance from a spend point of view. Okay, that's great. So moving on then to Stuart to take a look at vulnerable customers.
Thank you. Sort out our slides. Good help with that?
Yeah.
And whilst the slides are just being sorted out, I'll just respond to a question that's come through. I touched upon data and big data, and there's a question that's come in about whether the plan itself considers the impacts of GDPR. So GDPR, the General Data Protection Regulations, which relate to data privacy. Although I don't recall a very specific reference in there to GDPR as a regulation, my colleagues are confirming that. Clearly, data privacy is a concern for all firms going forwards, and is a major piece of regulation and legislation all firms need to deal with. There are some key challenges with that in terms of obtaining consent from individuals, from individual consumers in terms of how their data can be used, as well as the right to be forgotten. So whilst the FCA's plan is silent on that, it's absolutely a challenge which banks need to rise to over the coming months.
Okay, Stuart, just want to talk over the slides so the slides are keeping up with the sound. Sort out this background.
Okay. So we're going to look now at the treatment of existing customers and of vulnerable customers. So the whole concept of the treatment of customers really is at the heart of what FCA has been doing across all sectors over a number of years. So it's not a new concept, but the plan this time around does give some insight into specific areas over the next 12 months or so. And as expected, there's a particular focus on retail banking, retail lending, pensions and insurance. But I think it's also important just to note that there is increasingly a read across from what's pure retail, if I can phrase it like that, to some of the more global markets and investment banking products and businesses, where some of our clients are making progress to take the principles of what's being applied in the retail world to the more commercial investment banking clients, particularly at the smaller end, the mom and pop shops and the small businesses. So I'm not going to dwell on that any further, but I think it's a point to dwell on and to take note of. As mentioned earlier, the FCA is of course aware of the link between the treatment of customers and culture and conduct. So that's also worthwhile bearing in mind. Vulnerability and access are challenges in any consumer market, but particularly so in the context of financial services and in banking, partly because of the long-term nature of many of the products and the complexity of them and the kind of information that's provided, but also because vulnerability covers a wide range of situations and can occur at any time in the consumer's journey with you, during their relationship with you. So what are the issues and the focus for FCA? Well, general issues around transparency, freedom of choice, and enabling the customer to make rational and informed choices, thus ensuring the onus of responsibility lies firmly with the firm when developing products, communicating those products, and nurturing the ongoing relationship with the customer. The message seems to be that a firm's responsibility does not end once the customer is onboarded, but it continues throughout the lifespan of that relationship. So a customer, for example, may become vulnerable at any point in a relationship. So the firm will need to develop systems and controls and reporting to identify those potential scenarios. So that could be things to do with spotting when someone who's fairly good at making their payments on their credit card suddenly stops to do so. Why is that, for example? Or on a long-term contract, or say a critical illness policy. It could be because they've lost their job. It could be just disorganized. It could be there's mental health issues, they're not able to make rational decisions. But there's an emphasis by the FCA wanting to see firms actively engage around their customers to ensure that where there are vulnerabilities, those are identified and dealt with, and to do so early rather than when it's too late. I think also FCA is wanting to make firms not take customer loyalty for granted and to keep pushing on improved service and improved outcomes. In their mission statement, the FCA pledges to prioritise customers in vulnerable circumstances. So, for example, consumers who are not able to shop around as easily as others. This signals a subtle shift in their approach, and the suggestion is that firms should keep a close eye on how it implements this in practice. There are societal and technological changes, some of which we've touched on already, that have increased the scope and the sophistication of financial services. And their critical importance also affects consumers who are less capable of understanding those services, and those who are and may become vulnerable over time. So FCA is looking for better outcomes for consumers, and this ties in with what the government is looking for in terms of financial services in the interests of consumers and the businesses they serve, the greater good and the social good of banking. I seem to have... Yeah, there we go. There we go. So, FCA is expected to publish a customer approach document to ensure that it can identify people in the market who may be vulnerable. And this document will also set out customer protection objectives over the next 3 to 5 years, provide an overarching strategy for addressing the needs of UK customers. So we've included here a list of sector-specific activities and reviews that are being planned or underway over the next 12 to 18 months. It's not an exhaustive list, and I don't intend to dwell on talking on each of them, but it's there for your benefit. I think also, in addition, retail banks should prepare for the 2 newly announced mortgage thematic reviews, one on how firms treat borrowers whose interest rate-only mortgages are approaching maturity, and another on forbearance to customers in financial difficulty. The regulators looked at both of these topics closely in recent years, but it appears to remain concerned about whether firms are treating customers fairly. So what is the communication plan, your communication plan, that highlights, for example, exit fees, the possibility of transfer to a new repayment loan, strategy for supporting customers in difficulty, and how does this tie into managing reputational risk, development of repayment schedules, kind of information requested and provided at the point of sale or advice, and into product design. These are just a few ideas. The business plan states that further improvements need to be made competition, basic standards afforded to consumers. In particular, the FCA has identified the following issues. The risk that tough economic conditions may lead firms to manage back-book customers into more expensive or into default products. A growing number of over-indebted mortgage holders and those with limited access to credit. Risks to borrowers of a rise in interest rates. Firms might restructure products, bundle together add-on services to make comparison difficult or to lock borrowers into higher rates, and unjustified exit or switching fees, which reduce competition. I've been told we're running out of time to the last 10 minutes, so I'll just move on very, very quickly. So what should we do in terms of responding to the FCA business plan? Well, I think the first thing is really to identify which of the issues that FCA is looking at that is most relevant to you. Think about where the thematic reviews, to the extent that they're relevant to you, identify what those are and build that into your own planning. Talk about amongst yourselves as to what your messages are, what work you need to do, what your research and information is telling you. And then to make sure that the right information communicated to senior management and across the relevant risk committees and so on, so that you as an organisation are ready for that thematic visit should you be caught by it. I think overall, particularly within the retail markets, it's clear that much of the FCA's focus will be on how firms deal with vulnerable consumers, mentioned that several times, where their approaches might lead to consumer harm. This provides a strong signal to where firms should be focusing their efforts. So in particular, retail firms should carefully review their policies and practice around the whole topic of vulnerable consumers and make sure those are aligned to FCA's objectives. I think on a point of pragmatism, and we referred to it earlier, it's probably as much, if not more, to do with explaining the direction of travel overall, the pace that change has been reduced over, than absolute one-off bits of change. Products over time might need to be replaced or overhauled, and in the meantime, perhaps it's more about having sensible policies and practice around the needs of customers, those who are vulnerable, how we identify them, and the steps to be taken on a risk-based approach to identify who may be vulnerable or customer sets that are being unfairly discriminated against. To leave you with some questions to take away and discuss with colleagues, how will our strategy for technological change impact the customer sectors we serve and those we intend to serve? The idea of moving to apps and mobile phone banking, how will that affect those perhaps who are getting on in life for whom that kind of change is difficult for them to deal with? What ways do we sufficiently cater for and understand the levels of capability, financial capability within the customer base? To what extent do our products and services begin possibly to exclude sections of the population? And how can we demonstrate that we have an understanding of the resources and the adequate systems, such as the red flags when a customer becomes vulnerable, or at least would indicate that they might be vulnerable? That's all that I have to say. Happy to take questions.
Okay, thank you very much indeed. And just a couple of questions I know that people have obviously raised as well. But a question from your side of things, fingers and buzzers for this. How confident are your clients of meeting regulatory expectations in the areas that we've highlighted? I know that's a massively open-ended question. Sorry, but we've got you in the room, so we might as well ask the question as well. So how confident are they? What's keeping them up at night about the business plan so far?
I think AML, financial crime, has been a huge area of focus and will continue to be so. The FCA have shown willingness to enforce in that area, so that and the increasing complexity of requirements means that's a big area of focus. The technological change is an interesting one because there's risks and opportunities. So we see firms looking at cybersecurity, for example, trying to explain things to their board, trying to get a focus away from the very specific nuts and bolts of technology solutions and answers to prevent cyber attacks, and more into the risk sphere of how do we manage this? How do we set a risk appetite around this? You know, cybersecurity is in many ways very similar to any other risk that you would manage. It needs management oversight, senior manager buy-in and challenge, and everything else. So that's an area I think, Derek, that's had a lot of interest recently.
I think you know, as sort of shown with the poll question that we put together, you know, there's a very large range of different technologies which are already now starting to have an impact on the industry, and some of which are just around the corner. So actually, the pace of change itself, and understanding which of these technologies to get close to, which ones to experiment with, you know, which ones are already delivering competitive advantage. The FCA itself is starting to pick up on this theme around AML and KYC. And actually the part of the answer to some of these challenges could well be to put more emphasis around how technology can apply to the problem. So it's already seeing, if you like, a number of technologies which are delivering business benefit and can help from a regulatory perspective. And again, there's an underlying theme there from the FCA as well around the benefits of applying technology to ensuring regulatory compliance. There's looking across large data sets, large sets of information around customers, therefore being able to apply more appropriately both internal policies but also regulation through the use of RegTech regulation.
Yeah. Obviously, the question of culture and conduct
Absolutely.
is never far from the mindset of member organisations as well as the FCA, and quite rightly so. How are firms, in your experience, in measuring and monitoring that, and also producing the MI necessary for the board and also for NEDs? I would just like you to answer that in 2 minutes, please.
Well, I think the first observation, of course, is that I think a lot of our clients struggle with proportionality, and you know, what is relevant to a large organisation, complex multi-divisions, big matrix management, cross-border issues. Very difficult to translate that into smaller organisation, and interesting to see how FCA deals with the second phase, where organisations will be apparently smaller. So that's the first issue, the first challenge. So what is proportionate in terms of senior manager reporting, board level reporting? There isn't, I'm afraid, an easy answer to that. I think it will be a question of suck it and see. And I think the other flip side to that, of course, is that I think increasingly the FCA, given its exponentially rising firm base, will probably increasingly even more be focusing on the larger organisations, because that's where they see their risks are. So you know, it'd be a textbook answer, but you know, I think the increasing likelihood that you know, we won't contact you until some crisis. But I think, you know, woe betide you if you're found wanting, which is very unhelpful. But I think that's the reality.
I think there's another aspect to organisational culture as well, which is quite difficult for grasp, which is fostering a culture of internal innovation as well, and competition. So there are a couple of things pulling against each other here. You know, extremely prudent and to manage your risks extremely carefully, whilst at the same time, from a point of view of innovation and taking on board a greater risk appetite in certain areas, those two things are pulling against each other. So, you know, it's true to say that you know, understanding an organisation's culture and looking to create changes in that is becoming increasingly important, both from a risk management perspective, but also from an innovation point of view as well.
MiFID and GDPR are obviously on top of the agendas of many firms, and you know, time is running out and deadlines are fast approaching on that. Is that referred to in the business plan? as such, and if so, well, what should firms be doing now on that?
I'll start.
Shall I go on then?
You've got MiFID on the GDPR.
So on MiFID, we're in the middle of June now, nearly, and so with the deadline of the beginning of next year, if firms aren't well advanced in not just in planning but in design and implementation and getting ready for testing, then it's going to be very difficult to see how we can get into a good place in January. I think FCA in the business plan just assumes that firm will comply, although there is some signs of, on the periphery, on the edges, where things are still unclear or not certain, because they're never going to get that clear or certain. Then best intentions, best endeavours, document why you've made assumptions to deal with a particular issue. But that will be the pragmatic approach, and that's been a consistent message, to be fair to FCA, over the last 18 months to 2 years. And the fact that firms have had an extra year just means that their expectation of the standard they're attaining to will be that bit more. So I'll leave GDPR for others.
Yeah, I'm very glad GDPR, conscious of time, and also the fact that I'm not a data privacy expert, so I can keep this quite short. So yeah, there's a tension really between what firms have been doing up to this point, as the cost of retaining data has become cheaper and cheaper over the years. We've retained more and more information, and actually, as an industry, we've become quite lax in terms of things like records management, actually understanding why we're storing data and what we're using that data for. So now that we've got vast quantities of information, and we've now got the technological capability to start getting more value out of that data itself by mining it, by using machine learning, etc. So at the same point in time we've reached that step, we've also reached a point where data privacy is extremely important from a consumer perspective, and also from a regulatory perspective as well. So there's always a balance here. And I think what firms are going to have to do is focus an awful lot on their data retention policies, on understanding what sources of data they actually have available in their organisation, where they've obtained permission to use that information, and that is a huge stock-taking activity in terms of really understanding what's out there, how it's being managed at the moment, where it doesn't have a right to use, repermissioning where necessary, and looking to archive data that no longer can. So firms need to be well through their planning activity and start looking at the implementation around data governance and going forward.
Brilliant. We've run out of time, unfortunately. We could have gone on for a good hour longer. The panel have very kindly said that they will be able to answer your questions. So if you want to keep the questions coming in, please do so. Please email me directly, philip.allen@bba.org.uk. I'll be more than happy to answer that directly to you. Also, please complete the survey, which you will find in the widget on the right-hand side at the bottom of your console there. My thanks to Bernadine and Derek, and also to Stuart for their time as well. We will circulate and distribute the slide deck to you in the next couple of hours, of which you will get a copy of the on-demand version of the webinar indeed. Thank you very much indeed, and have a great day.